And why are there two waves in price inflation? Well, it takes time for money that is printed to go out into the economy, and it goes out in waves, and the second wave is already upon us.
In a world where economic tides ebb and flow like the sands of time, Rafi Farber stands out as a beacon of insight. He poses a thought-provoking question. Why do we see two waves in price inflation? According to Farber, it's because printed money takes its time to permeate the economy, moving in waves. As the second wave crashes upon us, Farber predicts a stagnant consumer price index, CPI, and a weakened Federal Reserve, constrained by financial crisis. However, amidst the chaos, Farber sees opportunity. He believes there will be a final surge in the gold and silver markets. Rafi promises to delve into his experiences and analyses further in the video, so be sure to stay tuned until the end.
In this week's Silver Report, we're going to focus primarily on gold. Gold is in a situation it has not been since late 2018, when it began a nearly 100% rally from late 2018 to August 2020. 53.6% of the total COMEX gold stockpiles have been drained out since Silver Squeeze, and more than twice that amount has been squeezed out of all gold funds since Silver Squeeze. Gold in $1959 in uninflated dollars is still $42.22, and I'll show you the chart that one of my subscribers cooked up for me, a physicist actually, shows that in uninflated dollars, if you take out the actual inflationary factor, gold is still what it is statutorily at $42.22. People have been making a big deal about long-term rates lately, but if you look at long-term rates, 10-year rates, treasury rates from 2020 to now, you'll see that we've just been bouncing off the 50-week moving average, is very similar to what we saw in the late 1970s, when after the final bounce, we headed vertical to about a 20% interest rate. We're going to take a look at their proven and probable mineral reserves for 2023. This is a press release that just came out last week. So we see here their proportion of silver to gold. You see here silver is 9.8. This is in millions of ounces. So 9.8 million ounces versus gold, which is 2,691,000 ounces, which is 2.7 million ounces. So if you take the ratio here, just so you have an idea of whether they are gold focused or silver focused, this gives you a good impression. If we take 2.7 divided by 9.8, that's about 3.6. So it's about 3.6 to 1 favoring silver over gold. 3.6 to 1 really favors gold in terms of revenue, because even if we get to a 15 to 1 ratio of gold to silver, which I think we will in the end game, we're still at only a 3 to 1 ratio of silver ounces to gold ounces here. So this is heavily favored by about 5 times in favor of gold, even at a 15 to 1 ratio. So Fortuna Silver Mines is more accurately now Fortuna Gold and Silver Mines. We see here similar ratios in measured and indicated. This is 9.9 million to 888,000, 9.9 million ounces of silver to 888,000 measured and indicated ounces. And for inferred, we have 19.3 million ounces of silver versus 1 million ounces of gold. At a 15 to 1 ratio, that would be about even, but I don't expect to stay at a 15 to 1 ratio. The current situation we are in the gold futures market, we haven't seen this since late 2018, and before that, we haven't seen it at all during the current gold bull market that began in late December 2015. So this I went over briefly last week. We're going to go over it again because open interest has fallen even further since last week, putting us in a situation where we haven't been since late 2018. If you look here, it's hard to see here, but focus in a little bit if you can see it. You see here in this rectangle, this is back when open interest, the number of contracts open on the COMEX was where we are now, 407,000. I think it's like 408,000 now, something very, very close to this. This is on a 1-day delay, 2 days by the time you're seeing this. So here we have, I think this is open interest of exactly 400,000 in late 2018, if I zoomed in on a different chart. But you'll see here a little bit of a sell-off in gold in around November 2019, with this little sell-off in this little bottom over here that led to a giant waterfall decline in open contracts, and we hit that 400,000 level. So a minor sell-off leads to a big closing of contracts, waterfall, and we have a low here. And from that point, we were just below 1,200, and we hit a high of about 2100, just below 2100, let's say 2090. So that's about 100% move. It's a little bit less, but the point is, once you have open interest numbers this low in a bull market, it signals a lot of fuel for a very big rally. And this was the biggest rally we have had in this bull market, the biggest, longest, and most sustained, about 100%. I don't know when this rally exactly is going to begin, but we have the fuel for it to last long when it does. And we'll see how much lower we can go in open interest. But we see that the low open interest, these contracts closing has not affected price that much. We have a very brief rally here from 2000 in the last few weeks. You can see at the end of this chart, and open interest has just fallen since then. So we might be at a bottom of price by about $2,000 here. Could be the floor. I don't know for sure, but this looks to be very strong. Potential rally coming. When it begins is another question, but the fuel is definitely there, judging by these open interest numbers. That means very, very low interest in gold derivatives. Why is that? I believe it is because the demand for dollars is going higher as the final financial crisis, dollar crunch, comes upon us. Quick look at what's been going on in the COMEX. I haven't reported on this a while. I don't follow it actively that much, but I do check in every few months, and I've checked in recently, and this is what I've found. So the gold supplies in the COMEX continue to fall since silver squeeze. We've fallen here. Here are the calculations I made. In the last 3 years, we fell 21.26 million ounces. This is eligible and registered, all the physical gold. This is the actual stuff that's in the vaults. So 53.6% of the supply has been drained out. That's over half in the last 3 years. In the last 22 months, it was about 50%. So half in 22 months at this rate. In the next 22 months, it's empty. I don't know what exactly is going to happen because we've been saying that for a long time, but this is just for tracking. So in the last 9 months, we've drained 5 million ounces. That's 21%. In the last 2 months, it's been 2.6 million ounces. So this has been a very quick, very fast drain here. Since around December 2023, the last 2.5 months or so, the drain in gold continues. And it's not just in the COMEX, it's across all funds. See here, the blue line is across all transparent gold funds. We have fallen about 45 million ounces since silver squeeze, that line over here. And if you take COMEX as part of this, COMEX is responsible for about half of it, for 21.26 million ounces, or a little bit less than half. But it's not just COMEX. Gold is being drained from all paper funds. I think it's going into a combination of central banks and private stackers. It's a race between the central banks and us. I don't want them to win, and they won't win because they'll have to sell their gold anyway when their currencies collapse, which is close at hand. Let's go to the second wave of inflation, the 1940s versus the 1970s versus now. We've seen this before, where we have a strong wave of price inflation, what the Keynesians call inflation, what I call rising prices, what normal people call rising prices, but there are very few normal people these days. We had here in the 1940s a 24-month lull. We had a first wave over here from the outbreak of World War II, when it really started affecting the prices, from, let's say, what is that, 1941, late 1941 to, that's when Pearl Harbor broke out, and the United States entered World War II. I wasn't alive at that point, so I didn't enter anything. So from 1942 to 1944, I think this is May 1942 to May 1944. So it's exactly a 24-month lull, a lull in price inflation, and then we began a second wave. I think that price controls were what were causing constant price inflation here, a constant rate, because we had price controls here, which didn't really work, but it did finagle the statistics. And then we had an explosion in consumer price inflation with the end of World War II. And it took some time for production to ramp up again. But anyway, we had two waves here, and the second wave was more intense than the first wave. Now, in the 1970s, we saw something very, very similar. This is December 1974. December 1974, we hit a high in price inflation of about 12.1, 12.2%, whatever it was. And then 24 months later, exactly, in December 1976, we hit a low just above 4%, maybe 4.5, 5%, something like that. And then we had a second wave of consumer price inflation that was even stronger than the first after a 24-month lull. Now, this is what we have now, right? We have the first wave of inflation. This is post-COVID here. And we have the first wave of inflation going up here from about March 2020 to June 2022. So far, we have had a 19-month lull in consumer price inflation that has been descending on an annual basis. It doesn't have to reach 24 months exactly. There's no exact science here. There are no constants in human action like that. And why are there two waves in price inflation? Well, it takes time for money that is printed to go out into the economy, and it goes out in waves, and the second wave is already upon us. And given that the second wave is already upon us, I don't think we are going any lower in the CPI. And if we are not going any lower in the annualized CPI, as cockamamie as that, what kind of word is that? As cockamamie as the CPI is and how manipulated it is, it still shows trends. And since we are not going down in the CPI, then I don't believe the Fed will be able to cut at all until it is forced to by a financial crisis. And it is that final crisis that will cause the final slingshot in the gold and silver markets. And at that point, we will not be able to get in anymore. And in my humble opinion, the final rally in the real money metals will be so intense that it will scare even those of us that are true believers, because we'll know what's going on and we'll know what happens to society when gold and silver can no longer be exchanged back into the local derivative anymore. It means that the entire division of labor has to be restructured, which is a good thing, but it is a very painful thing. And we will see how many people are in the wrong place in this division of labor, which makes absolutely no sense. And it has to come to an end. And it will come to an end when the currency dies and real money reestablishes itself at the bottom of the pyramid.
As Farber's words echo away into the distance, we're left contemplating the implications of his prophecy amid the stormy seas of economic uncertainty. Yet, one thing remains crystal clear. The currents of change never cease. It's only those who listen to the warnings of visionaries like Rafi Farber who stand a chance at navigating these turbulent waters. Stay tuned for further insights, revelations, and clarity in the ever-evolving realm of global finance. To our loyal viewers and supporters, we extend our heartfelt gratitude. Keep supporting us by liking, sharing, and subscribing. Thank you.